This conference will now be recorded.
Good evening, ladies and gentlemen. This is Real Estate Trading Frank. It's approximately 8:13 p.m. On May 2nd, 2019. This is a strategic midweek webinar, delayed by a day from yesterday. Had a family appointment to attend to. Session will be recorded, uploaded to the Google YouTube channel for viewing by all other members and anyone out there with the internet connection. Feel free to spread the word that they can listen to some and profit from some very valuable videos and forecasts and the ultimate resource for understanding the real market, not necessarily, for a better choice of words, the fake market that you keep on hearing about in the media and stuff. We're always grappling around for reasons why the markets are doing what they're doing. Here at Real Estate Trading, we like to get to the heart of it. And with my experience back from my days on Wall Street and my in-depth passion for deep passion for the markets, I try to get to the bottom of what is going on, and I think I hit the nail on the head most of the time. So I'll explain some of that today as to why some of this turbulence has happened. Part of it is technical, part of it is macroeconomic, and so that you all understand that this is not the end of the world, but we are hitting a slightly turbulent patch where you have to be more cognizant about the type of stocks you trade, how you trade it, and you have to trade it through the charts, period. That's it. There's no way around it. Full disclosure, this is purely for financial education, not for any solicitation or advice, and we shall begin. We have a great new member who's been with us, Mike Murphy, very passionate about understanding the markets, making some money off it. So Mike, welcome, and anyone else who comes in as we continue with this session. I'll try to keep it as brief as possible, but they always last at least 45 minutes to an hour, so I'll try to see if I can do it within that time frame, which I need to do today because I have a few other things to take care of. So on that note, let me give you a quick synopsis of what's going on. You see these charts every single day on my real-time Twitter feed, which is where all the content is delivered. It is a running commentary on the stock markets from pre-market all the way through end of the day. And even after that, sometimes I post some very important articles which are relevant to your profit and losses on your trades, and also or relevant to what the market will be doing going forward. But generally speaking, even if you're busy during the day, just scroll through the Twitter feed, take you maybe 15 or 20 minutes, look at the charts, read the comments. They're very brief, 2 or 3 lines, and you will get a full understanding of what happened that day, and feel much more comfortable. Nothing is more dangerous about trading and investing than not knowing what's going on. And I think all of you will agree with me on that. Just by looking at prices and seeing the price action does not tell you anything about the stock market. And that's what Real Estate Trading comes in. We're not just a stock alert system and fantastic precision tactical charts. We're also an educational service which tries to make traders and our members more independent in what they're doing, so they are not fully always dependent on a tweet coming here or through where to buy and where to sell. You need to make your own decisions, and we provide all the tools for that. So I hope you all understand that very well. On that note, couple of broad things. First of all, the market is hitting a turbulent patch. We are in the midst of some heightened volatility. In other words, what you're looking at, this is not any type of geometric linear line. And let me try to change this color here. It's not like the markets are going up in a straight line. They're moving in between channels. They're moving in between patterns. And then you have these flash crashes that start off around 2:30, 3 p.m. like we saw yesterday, right after the press conference. I'll cover that in a minute by Fed Chairman Powell. These type of flash crashes after the market opens higher, then the reversal bounces. So these are not straight line linear patterns where you expect what most retail traders, the normal retail trader out there, meaning the normal individual trader, likes to think. We all like to think that, but that's kind of daydreaming in la la land, that everything just kind of goes up like this. No, it doesn't. Even if the markets have been going up like this, when we look at the longer term charts that I show quite often, but in between, we see intense volatility. Sometimes the market just goes completely off course. We chart it and we structure it so we understand how far it can go, where it's going to bounce from. It is not an easy task. You all know that. I know all of you appreciate all the hard work that I do in the background, but I will tell you, it becomes very, very hard when random flash crashes happen. So I have to redraw immediately in real time these charts so you all can see where we can drop to in extreme circumstances and then where we can bounce from. Most of the times, even including today, I have been right. I said we would drop somewhere in that 2,900 range on the E-minis as well as on the S&P 500, and that's pretty much what happened. Round numbers are good, but they don't always tell you the full story. But at least on the chart side, it worked. So saying all that, the belief that whether a stock or a market is going to continuously go higher on a straight line or continuously go lower in a straight line is a myth. So I highly suggest that mentally, very hard for people sometimes to comprehend that, even though they try. That little voice keeps on saying, hey, I bought this. It's just got to go straight up from here. It just doesn't work like that. So let's cut out that mental myth that's propagated that markets can always go, markets go up in a straight line and markets go down in a straight line. You will hear a lot of commentators on TV who will tell you that the markets have been a straight line up since 2016. That's a blatant lie. Okay, that is the biggest fake news, fake financial news that you'll ever hear. You hear a lot of commentators say that, whether it's a reporter or whether it's a analyst. Oh, the markets haven't. Markets have been going straight up since 2016, since the elections in November, or markets have been going up straight up since 2010. That's all hogwash. It's complete garbage. It's complete lies, complete fake news. Why? Because markets in between, as we will see, and I've shown many times on longer term chart, have had severe corrections. In some cases, 20% type of corrections, which we incurred just in the month of December. October to December of 2018. Those are severe. Yet the markets overall have maintained their primary uptrend higher, which is still the case as we will look at the longer term charts. However, in between, we will hit turbulence, and we are hitting a turbulent patch right now. So on a broader topic, earnings are coming in fast and furious. We are hitting some real big ones, and we are getting nailed on a couple of smaller ones. Net, and of course I keep a whole tally of that. We are, generally speaking, 60 to 70% of my calls on the earnings have zoomed higher. Some of them have just rocketed. Tonight we got a hammer on the head hit with ANET, Arista Networks. Yet we have had huge move, bigger than that, a 13% move higher on Meli, Mercado Libre, which is the Brazilian or Argentinian Google, and it's Argentinian, I believe. Yeah, Mercado Libre. And that's up $53 and $45 down on the ANETs. So that's going to actually make up net if you just look at those two trades, the money lost on the ANET trade, because whenever I do earnings, I try to buy a basket of the earnings. Not everyone is capable of doing that. I understand. But at the same time, you always have to be spread out. Then we have had other moves like Data and a couple of other ones which are down like about $1 or $2. To make a long story short, so net, the earnings have worked out very well. The biggest one that we can think about in recent days is Apple. Apple was absolutely huge. Those calls went berserk. They went from roughly $4 or $5. I believe they were the 205 calls, to almost $12 for Apple. That's huge. And then at the same day, I told people to buy the 215 calls, which went to 210 or 215 calls. They were at $1.88. They went to almost more than $3.50. They were actually higher by more than 100%. So we have had huge winners. We have had huge winners, and we have had some losers. That's the earnings game. Some people play it, some people don't. I think that it's a good way to. It's a pretty tactical way. You have to be risk orientated to build up small accounts into bigger accounts, because you sell them the next morning, and you just see the accounts just jump 30, 40, 50% based on those baskets. Anyway, that's up to each person's decision what they'd like to do. So saying all that, we're in the thick of earnings season. We're coming towards the tail end of it, but there are quite a few earnings coming out in May too. So it's not ending right away. The big ones are out. So then we have what is in reality going on with the Fed Powell thing. Fed Chairman Powell, and I don't want to get too deep into this, basically said nothing wrong. He said he's not inclined to raise rates, and he's okay with. He's happy with the strength of the U.S. economy. He's not inclined to raise rates, and that depending on the data coming in, they will see what happens. If the U.S. economy keeps on getting stronger and stronger, and inflation starts to creep in the form of our regular basket of goods, that's how inflation is measured, CPI, consumer price inflation, or wage inflation jumps up, you don't want the economy to overheat to a point where they'll have to raise rates faster. So he might consider raising rates a little bit if he sees that happening. However, he did admit, and this is I'm just making it quite simple, that he sees inflation below par. Inflation is simply the cost of goods moving higher, everyday products that you buy. Okay, so you don't want prices to be out of control because that takes away your buying power. And that $1 doesn't buy you as much as it would if the price was moderately cheaper. Really easy to understand. So he basically said inflation is running below par, and he's not concerned about runaway inflation. Markets do what they do. It's somewhere in there. And this is really what happened, and this is what the technical reason is why there was that sudden sell-off around 3 p.m., which caught a lot of people, including me, by surprise. That's it. That's what you call an immediate flash crash. And we were doing quite well before that. We took down nice profits, but the other positions that we added on also slipped down. Yet they were still positive, Alibaba included, which was a huge winner today. Qualcomm too. So here you're looking at, and I did put this on the Twitter feed today, so please kindly review it and to see it. The government bond yield. This is let me change the color. This is 2.46%. For some of you who don't quite understand it, I'll try to keep it real simple here. This is the TNX, which is the 10-year government treasury index that all our benchmark borrowing rates generally are benchmark. Credit card rates, mortgage rates, auto loan rates, all the big ones that we all pay. So this 24.6 doesn't mean 24.6%. In that case, we'd be living under a cave, completely penniless. This, excuse me, this is 24.6. You're going to move the decimal one to the left. It's 2.46%. Okay? So the 10-year government bond deal, which was falling apart, and at that time the market didn't like it either, was that there was an inverted yield curving. Don't worry about that. Listen to one of my older videos to understand what that means. The market didn't like that. Like, oh my God, rates are dropping this fast. Everything's going to hell in a handbasket. This is a direct precursor to a major recession coming. So what happened? First of all, there's no recession. All the numbers are coming out pretty strong. Job numbers are coming out really strong. Economic numbers are strong. China's picking up, which is a major global catalyst for global growth. So all of a sudden, the market forgets that, right? Now, rates moved up about 4% from here to here within 48 hours since Wednesday. So in simplistic terms, this move up is a sharp move up, as you can see that through the charts. So when bond prices go higher, when bond yields, so I'm going to say bond prices go lower when yields or interest rates, they call them yields, so I'm going to say BY, go higher as it's doing here, real sharp. The 4% move is sharp, okay? That's 4% from 2.46% to 2.56%. So that move is 4%, okay? Not that it went to 4%. It's just the move is a 4% move in one day. Remember, bond yields should climb higher. That shows there's a demand for money. That means there's economic growth. So that's fine. But if it moves 4% from 2.46% to 2.56% in 48 hours, the speed and the ferocity of the move pushes bond prices lower because they are inversely proportional, right? Bond yields moving higher, bond prices go lower. So you start getting, it's just like a stock. It's just like you own 100 shares of a stock and it drops from $10 to $4. And most of these big hedge funds, institutional funds, which own bonds, they are leveraged, which means they borrow money, right? They have leverage. And all of a sudden, you get big, fat margin calls, institutional margin calls. So if a stock falls from 10 to $4, then let's say you own 10,000, let's say bigger institution, for example, owns a smaller fund, for example, owns 10,000 shares, and he or she is on margin, then all of a sudden you get margin calls, big fat margin calls. You got to come up with the money to cover the margin debit if it goes below 30% or 50%, depending on what the margin requirement is. Okay, that's the reality of what happens out there. So the same thing with bonds. They have bonds bought on borrowed money, i.e. leverage. Bond prices collapse hard as bond deals shot up like crazy in 48 hours. What do you think is going on here? They're getting massive margin calls, and this is not the first time it's happened. Okay, we have had a big one like that. I remember in 2016 or 17 that it was called the rate tantrum. When rates were going nuts, taper tantrum, and so the margin calls come fast and furious. They gotta sell bunches of their bond portfolio, and a lot of these funds own stocks with it, stocks which are the big name stocks primarily. They got to sell some of those too in order to raise the cash to pay the margin calls. Well, what do you think happens? It has a ripple effect through the markets, and the markets have that sudden impulse flash sell-offs, which take everybody by storm, and then the reporters out there and stuff all looking for a reason as to why that happened. Nobody talked about this on the news, did they? Did any of you ever hear this on CNBC explaining to them that the bond market basically had a very turbulent time because bond prices fell sharp? And remember, the bond market is much bigger than the stock market. So the bond prices dropped that fast, that quick, because yields rose that fast, that quick, within 48 hours, and that caused turbulence and forced selling within those portfolios that caused the markets to also, in sympathy, come down for no reason, honestly speaking, because this has nothing to do with Powell. He didn't do anything wrong. He didn't scare the market in any way or form yesterday. But you didn't hear about this anywhere else. You're hearing it now. Here, that was one of the major reasons, money reasons, as to why the markets came under pressure. And then they started to move up today. There are a lot of green on my screen across the board. Not every stock that I own. But overall, first part of the day, there was a lot of green. And then the biotechs were mostly green. The banks were green. The food stocks were green. The Domino's pizzas were green. The Chipotles were green. The Shack Attack, the Shake Shack, up nicely after hours. Goldman Sachs was green. Whole bunch of selected tech stocks were green. So the market did absorb a whole bunch of that selling. But just so you understand, this move of 4% net change from here to here on the 10-year government bond market caused bond prices, and I'm going to wrap up this very quickly, bond prices to collapse, not collapse, so come down really hard, just like a stock price, because these bond deals moved up so fast, so quick, that caused the turbulence and an overall negative effect on the markets. Just so you all understand that. This also has a direct effect on the US dollar and all that stuff, but I don't want to get into it right now. The US dollar is stronger. If the US dollar keeps on shooting higher, it's not necessarily good for the stock market. Why? Because it causes our exports to become far more expensive for the rest of the world that buys all our exports to buy from us. It also causes the debt, the global debt, sovereign debt by other countries. It's marked in US dollars. US dollar rules. US dollar, okay? Not in Chinese yuan, not in Russian rubles, in US dollars primarily, and in British sterling pound. So the US dollar gets really strong, it causes them, more pressure because they got to pay back that interest in US dollars. Their currencies weaken, it's not necessarily good. We want the US dollar to remain stable to slightly lower. Okay, so let's take a quick look. So this is these pictures that I'm showing you, and it's not the first time you guys are seeing it. It's all on the Twitter feed. This is the face of massive volatility. If you have time during the day, you can trade these ranges pretty effectively. 15 minutes to an hour. You can scalp some good stuff. You can see that right, all of them are marked very clearly right there. You can trade these kind of moves, 20, 30% on the SPYs. You can short on the breakdown, again, 30, 40% on the low side. You can do that. Active traders can do that all day long. If you're looking for a overall swing trade, given the volatility right now, like overall swing trade on the overall market, it hasn't triggered it yet, just so you know. We have had a lot of great swing trades on the SPYs, just this week alone. We had some fantastic moves. When Apple opened up, those SPY calls went nuts. The Qs, the SMH, right? SMH was still green today. That's a semiconductor holders index. I introduced that as a ETF that people should trade to play the chip sector. So, but we are entering a volatile period right now. How long will it last? Could be a couple of days, could be a week, I don't know. We are coming through a quick correction, and we could turn around and blast all the way up to new highs on the China deal finally sealed and done, which is supposedly coming next Friday. So again, we shall see. So these are your day trading charts, which you can use even if you don't trade the SPYs to manage your own trades. You start to see a big sell-off like that, it's very hard actually. You know why? Because everything's happening in 15 minutes. By the time you think it's all said and done, the market turns around. The market turned around 11:45 this afternoon, right there. So the reason I put this out for active traders and non-active traders, so they can understand this is how the markets are operating in a state of what I call structured volatility. All the lines are drawn. They're not just it looks very random, but the ranges are very much in place with the downtrend lines, the resistances, the supports and stuff. The more you look at them, the more they become very familiar to you. And it happens to me. I look at this, it's familiar to me. I don't like it most of the times. Who likes it, the fact that you bought something here and all of a sudden it starts to crash down? But at least I am not trading in the dark. The most dangerous thing traders can do, especially retail traders can do, or any trader for that matter, is trade in the dark just by chasing prices. The prices are not giving you any picture, like a visual picture of these type of charts that I put across. You all know that very well. So please get used to looking at these things. I am seeing some structural patterns here. Let's see. This is where we were coming from. This was the broad channel the market was traveling in, again, through massive volatility. Then we hit the top. I said the markets would go towards 29.40 to 29.60. That's exactly where they went. And I've been talking about this for months now, if not for weeks. So it hit it there, and then we had started to get this flash crash. The flash crash started approximately at 2 o'clock or so yesterday, 2:30, and 2 o'clock, and it actually was green. This was a move higher. This was all lovely green because the right after the Fed came out thing, the market went like this, and then it turned red. This was like that, and it was looking like it was going to go higher. Then all of a sudden, like I said, there was a big fat sell program that came in for reasons that I just explained to you all 5 minutes ago. And then this caused this. This is not a random thing. This is just like taking everything to the woodshed, all right? And that's because somebody had a massive, fat institutional margin call that they needed to get rid of. Remember, most of the margin calls, especially institutional margin calls, which generally go from 10 million to 100 million plus, believe it or not, in actual sellouts happen between 2 and 3:30 in the afternoon, because the margin clerks do not want to hold that much money, because if they haven't wired in the money to cover their margin calls. All right, I know all this stuff back from my days on Wall Street. So they said, that's it, we're chopping you. Whatever you have in the portfolio, we're taking a bit off to alleviate the pressure of that margin call. That's why you get these very sudden drops, mostly around 2, 2:30, and 3:30. So, today we went lower. The market was moving up nicely. The market moved up nicely till about. Market actually opened up. Techs were doing really well, and then we started selling off around 10 o'clock. We got 2 rounds of, again, maybe they had some leftover selling to do. There were 2 red, very large candles. You can see that, small one, and then a big one. And remember, this is like a waterfall effect. You have stop losses, and all of a sudden the stop losses are triggered, causes more stop losses to be triggered as it moves down, and you get this panic move down. That ended at around 11 a.m. At around 12 noon, the market found its footing and started to move higher. And overall, the market ended on here at 4 o'clock. That's it. So that's the real story. This is the story of the reality of the market. What are markets going to go do tomorrow? Well, I can say, looking at this chart here, making a technical assessment, not an emotional assessment, a technical assessment. This is a falling wedge. Right there. That's why I draw this in this dark pink or magenta, whatever you call it. And if it breaks out of the falling wedge, then generally speaking, you get the next point of contact, which is around 29.40. Will it go all the way back to the highs here at 29.60? I have no idea. I don't know. I have no idea. Has it done it before many times, where the markets pulled back and then completed a full pattern, shaken everyone out, zigzagged, and then ended up back in that zone again? Many, many times. Many, many times. Just this week alone. Look at that. Look at this. So, the fact is that nothing, what I'm trying to get through to all of you is that nothing fundamentally changed in the background of the global markets or the US markets. The Fed is king. The king didn't say, when it monetary king, as in controlling the money supply of the liquidity in our system. They didn't say anything that they would drain the liquidity. Remember, draining the liquidity or quantitative tightening is the most dangerous 2 words that you want to hear. He didn't say anything like that. I know good old President Trump, my New York guy, is screaming his lungs out saying to cut interest rates. It is the most devastating thing that you could ever do. If he cuts interest rates right now, that means that the U.S. economy deep down is in deep trouble. Cut interest rates for what? Interest rates are low anyway. So for the average political masses, it sounds really great. Cut interest rates, well, that's great. Let's do quantitative easing. He's just feeding red meat to the masses for political votes. All right. There's a whole Democrats too, like, cut interest rates. Like, what the hell are you guys talking about? Cut interest rates for what? You cut interest rates, banks are going to collapse. That's going to take the market down. So they're just saying all that to make people feel good. Oh, if you cut interest rates, things are going to. No, it doesn't work like that. You need interest rates at this level and gradually moving higher. That shows that the body politic or the body of the U.S. economy is healthy. Okay? Cutting interest rates is like giving you an antibiotic because you're sick. So we are healthy. Do you go shoot yourself an antibiotic? Go to the doctor and say, hey, Pop, give me, give me a shot of antibiotic shot, or give me a real strong antibiotics because I'm feeling really healthy. I don't think so. You only do that if you're sick and you need that. So why the heck do you need to pump the U.S. economy with quantitative easing, i.e. cut rates in a healthy body, shoot an antibiotic or pump them with medical drugs on a healthy body? For what? That's the best way I can describe it, all right? So let's move on. So the key is that futures are up about 3 right now. We have the jobs number tomorrow. Who cares? Unless the job numbers are completely out of whack, meaning like, instead of 200,000 jobs, they draw like only 20,000 jobs were created, the market's just going to basically brush it off. Overall, it's going to be a strong jobs number from what it looks like. And at least these charts are telling me, looking at it, that this looks like a slanted W, and I see this level very doable. Okay? So you got to also keep an eye on that. And if you're trading, as a trader, it's your responsibility to keep an eye on these things. It doesn't matter how much I guide you during the day. Because every one of these lines that I draw, the market hits, pulls back, or busts a move. Seriously. And it's not rocket science. These are levels of selling, known as supply zones. These are levels of buying, known as demand zones. Demand zones, supply zones, all within certain ranges. And then I draw the patterns on top of it. These are downtrend lines, and these are uptrend lines, the green ones. That's it. All right. Now, this is the face of, now this is one thing, I don't want to spend too much time on it. Maybe you guys can look at it on your own because it's on the Twitter feed. I specialize in identifying patterns. Some people are very good at that. Some people are not good at that. And I'm not just talking about patterns and symmetry just in the stock market. I'm just good at identifying a lot of really sharp things even in my daily life. All right? So it's like you're almost like a sniper. You're like a, SEAL, like taking out the bad guy, somewhere out there in the deserts in Iraq from like 2 miles away, right? So you got the bad guy, like pinpoint. He comes out of his little whatever he comes out of, planting a bomb, and boop, he's gone. So I try to do things sniper style, all right, in a good way when it comes to the market. So when I'm looking at this chart here, I am seeing a lot of similarities. I am shading the area, showing you the purpose of shading these areas is to show you that there is a certain mathematical symmetry to what markets do. When markets went up like berserk and most of the retail traders were completely unprepared, and we were buying these nice tactical drops. The arrows were put in place, a buy here, buy the 2900, 2905, buy the 290 calls, 291 calls, 292 calls on the spies and stuff. And this happened on the 23rd. What day was the 23rd? 23rd was a Tuesday. That was last Tuesday. Okay? That was last Tuesday. So on the 23rd, bang, the markets just shot up like crazy. It was one heck of a rally. I think it was, 300-400 points? It hit the upper end of the range, pulled back, created massive volatility. I kept on saying, read my tweets, uptrend intact, blah, 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 looking at the longer term charts, and it was big payday. This was a huge payday, took some profits, and this one, you basically used it to set up your trades. Remember, there are setups and there are day trading, right? So sometimes setups are very clear. So this was a nice setup which lasted for about a day or so. And then bang, the market broke out of this yellow shaded area, what I kept on writing a bullish consolidation channel. Because the market came all the way from down here, ladies and gentlemen, okay? So I am just showing you the framework of what is happening right now. So they broke out of it, pulled back, retested it, fell into it, and then bang, it went nuts. That was on Apple earnings. Into the Fed meeting yesterday. And then this. So what I'm talking about, if you look at it and you spend a couple of minutes looking at it, you can see how symmetrical it is. This move is basically, this move up is this move down. Yeah, little slipped and slide, a little bit lower. This move up is basically this move down. It is very symmetrical. I have noticed these things for years, and now I'm really getting into it. Now, I'm learning every day, too. My brain processes information very fast, okay? I try to be as robotic as possible. So I noticed that whenever there's an impulse breakout, this is known as an impulse breakout. It just impulsively broke out for reasons, whatever the reason was that day. Okay, go through my Twitter feed, you'll read it yourself, or listen to my webinar, and it's there. So these impulse breakouts tend to be reversed and retested. That's exactly what the market did, and slipped slightly below that. And that was the 50 Fibonacci level. Then it went above and then did another move down. So this move here, this red area that I shaded, is similar to this one and similar to this. This one is very similar to this. So every action has an equal and opposite reaction. Okay, Sir Isaac Newton, you know that, right? Okay. So bottom line is, it is a fact. So this is a very mathematical geometric chart showing you that these patterns replicate themselves. Okay, patterns replicate themselves. So the patterns are going to replicate themselves, and the best we can do, worst we can do, is get down to 2890, complete the whole pattern, and then begin another cycle that will basically take us higher. Whether or not it takes us to that 2960 level, we don't know. But I believe that we can move up towards this, into this box. So the more you look at this, the more these charts are going to talk to you. It's not that hard, believe me when I tell you. But that's the purpose of this chart, to show you the levels you can trade off, show you the Fibonacci levels. The 50% Fibonacci normally is what markets, when they impulsively move higher, normally come back and test, or impulsively break down, will come back and test. And these are the other Fibonacci levels here. So looking at this here, it's too early to call what will happen if we open up. Let's say we open up 7, 8, 9 S&P points higher. They're going to sell the market. I've shown you guys all the time, because right there is your sell zone, right here. They'll sell the market, they'll take profits, the machines, and then they'll run the market higher if they want to go higher. So this is most probably what's going to happen tomorrow. Passing it on to you, and you can see it. Markets did this. Okay, what pattern is this? It's an inverse head and shoulder. Oops, sorry. This is an inverse head and shoulder. Here's your left shoulder. Here's your head. I'm sorry, here's your head. And in between, there's a lot of little head and shoulders, but this. See this? So it basically looks like this. By now, everybody should be totally familiar with the inverse head and shoulder. Here's your head. Here's your left shoulder. Here's your right shoulder, where we are right now. And there's a possibility that we open higher here at what we call the neckline. Neckline, again, access resistance. So when I'm trading the SPYs or other stocks I'm looking at the stock charts as well as looking at this, because it's giving me an idea where I need to bail or take my profits. Nobody wants to give away profits to the market. Unfortunately, that's what the market always tries to do, right? You're making money, and then it snatches it away from you. You think, oh my God, I suck. You don't suck. You're just not watching these charts, and the market's just stealing because you're not focused. The market's stealing the money away from you. And like I keep on saying, we're not special. What's so special about any of you? What's so special about me? Nothing. You think the markets give a flying, you know what, about us? No. So if you don't keep an eye on these things, they are going to keep on taking the profits away from you. And sometimes, for no fault of yours, you're going to get hit. That's different. So, so that's where we are now. Looking at the longer term picture, we do have a technical breakdown. Okay, there's no way around it. Now, does that mean it's the end of the world? No. You can. I zoomed in to show you the picture. This is bearish. I mentioned that yesterday too. That is a bearish engulfing candle, with the body of the candle. This was yesterday. Encompasses the previous hammer. That's no good. And this was the follow through today. This is on the SPYs. So what's the worst case scenario, which means would be the best case scenario for a tactical big time sharp bounce is the bottom of this range, 288.65. So having cash on the side to react to a sharp fall, this would be probably another 100, 150 points. This holds, then you're going to get a sharp move higher. That will most probably be the case as we get into the early part of next week with the optimism building around the US-China deal. Because the US-China deal is not a joke. President Trump and the team, I think they're doing a pretty phenomenal job. And regardless of some of these sources leaking out that, oh, they might be having disagreements, blah, blah, blah. Well, they're still there, right? They're still talking, and they both have to get this done. It's important for President Trump's re-election, and also for Premier Xi, the Chinese guy's survival. Not that he needs to get voted in, I mean, but to his economic well-being of China. So you can't afford another Chinese market meltdown, I'll tell you that. And we can't afford another meltdown in our markets either, even though our markets are, moving along nicely. So technically speaking, it is I would say a medium to high probability. I could be dead wrong, because this is just one chart we're looking at. I've shown you other charts on my Twitter feed, which are showing that we could have a sizable bounce just starting off in the next 48 hours. But this would be this is a bull flag. You can see that. That's a bull flag, and as long as that holds, then you'll get a sizable bounce. Now this is the reason I shaded these yellow areas, so some of you didn't quite understand it, is because I showed you that previous times, and each candle is 1 day, right? We have had these sharp corrections. Then what has happened afterwards? So I just wanted to show you this the similarity. So we could slip and slide more. I'm telling you right now, okay? Because we're in that zone here. But as long as we hold this big 287 type of SPY number, we're good. We break the 287 SPY numbers, we are moving really fast and furious. It's going to be quite easy to make some big money on the short side. You can make some money on the short side here too, but you got to be careful because these lines are still trending higher. I think all of you can see that. These are moving averages. This is the mid-Bollinger. Many, many times, as we have seen, it's touched these lines. It's come close to this mid-Bollinger, but before it got close, it turned around. So that's the reason why I find it difficult to get comfortable with any short position, because look what happened today. We were down 260 points on the Dow. We ended down only 122. A lot of shorts got decimated who came in late. So you got to just keep that in mind, all right? So when things are falling, it seems like, why did Frank come out there and say short, short, short? Because I know by the time I'm seeing these things, sometimes I'm reacting quicker, but sometimes they're happening so fast. I suggest that we put in a SPY short, and then some people get too excited. They're like, yes, I'm going to make a lot of money on this. The market's going to hell in the handbasket. And then the next thing you know, it turns around within 5 minutes and they're losing money right, left, and center. So, but you guys can do it on your own. You don't need me to tell you. If you like to do it, you feel free to just use your money on the short side. I show all the charts, so you know what to do. But unless I have a more conviction short suggestion, I cannot put it out there, even though I have done many days. So that's where we are. Looking at the internals, it looks like we are not completely oversold yet. Normally, stochastics coming down here is a sign to buy. Now, what I did like is that these sell-offs are so fast and furious that the faster, the better. Why do I say that? Just so you all understand, because no one, investing is a funny profession. Investing and in the markets or trading the markets is the only thing in the world that investors don't like to buy cheap stuff. It's crazy. You go to a car dealership, he's like, I'm giving away 60% off on the cars because, my wife wants to close down this dealership. So, okay, I'm divorcing, whatever. And you're like, Great, I'm going to get 2 of those cars. But stocks get cheap, people just don't want to buy it. I've seen it from the smartest guys on Wall Street, my clients back then, big shots, because we handle high retail net worth clients. You're talking guys with 50, 60, 70 million in portfolios. And they all ran when things got cheap. Most of you ran when things got really cheap, which was on Christmas Eve. And we were nibbling and buying. So this is the only game in life when things get cheap, good companies get cheap. Majority just want to sell and not buy. It's mind-boggling. That buy low, sell high, that's the most overused cliche ever. Because as far as I know, and I've been doing this for a long time, the majority of human traders never do that. They love to buy higher and get smashed, but they will not buy real technical or tactical lows when things are given away at a bargain. And that applies to a lot of you too. So anyone can change. You don't have to run in every time the market's down 200. Got to look at the charts, look at whether the technicals are really basing. Get in there. Get in there with something. A 600-point down day in the market, and many of you have seen this repeatedly. 400, 500 points. We have had some of the best days at Clueless A Trading because we have managed to get in some phenomenal prices. Intraday rallies have generated 300-400% as the market dropped from being down 600 to ending the day maybe down 200. Got to start thinking like that. Okay? If trading was that easy and everybody was making thousands of dollars every day, then why would there be any other profession in the world? Why wouldn't everybody be a trader? Because trading's not easy. But when you understand the concept, it is pretty easy. Where in the world do you get 200-300% ROI, return on investment capital, within a matter of a day or two, or if not the same day, sometimes? Nowhere. So think about it, nowhere. So you just gotta keep going at it, because you get a couple of those 100, 200%, you like it. And you don't have to play with expensive options either. Qualcomm, the low was, give you an example, the stock was plummeting last time. I'm like, oh shit, this sucks. Like, what the hell happened here? I had a bunch of it. I saw it starting to come up, and then I checked last, and I was just like, all right, we're gonna deal with that tomorrow. It opened down. The calls at around 2. They went down to 92 cents. We bought more around $1. Look at my tweet alerts. They went to $3.20. That's 200% reversal in one day. And then it pulled back from the 90 level. So there you go. All right. So remember, the only profession, only business in the world where things get cheap within reason, nobody's around. They all want to buy when it's feeling good. By the time you feel good, it's over. Trust me when I tell you. Then when you feel the crappiest and you look at the charts and they're showing deep oversold levels and all kinds of stuff I'm putting out there, like extreme oversold, McClellan oscillators minus 300, you want to just hold. You just want to buy. Are we there yet? No. Short term, are we really deep oversold? Yes. So just remember that, okay? That's the biggest piece of wisdom that I can impart on you, but it doesn't make any sense because, like I said in the other video, you can't get the horse to drink if it doesn't want to drink, right? So you just gotta change your horse. All right. So this is a chart of the weekly. Now this is important for all of us to keep in mind because this session we're trying to understand, like, whether or not we are in a really bad downturn. Is this the beginning, like the media will like to tell you? Sell in May and go away. Okay, go away where? To Venezuela? I mean, it doesn't make any sense. Sell in May and go. That's the most stupidest thing I ever hear. Like, okay, sell in May and go away. So in the meantime, last May and June, the markets had phenomenal rallies. So you just went away. Okay, great. oh, unfortunately, I don't have a sugar daddy and I don't have a trust fund. I got to work my butt out to make a living and take care of my beautiful family and our rescued pets and the charities and do all kinds of stuff. And so I don't go away. Okay, so I live within the market. So looking at this picture here, this is a doji. Okay, a doji is where the body of the candle is in the middle, right? So this is a doji. Doji basically means indecision. So the market right now, there's one way to look at it. The second is that this is also an inside day. Now, what is an inside day? The body of the candle, this body of this candle is still within the body of this green candle that was established last week. Remember, this is a weekly chart. Okay? So you guys with me so far? So this is predictive matter. Like, we're just trying to make a technical prediction. So overall, nothing really changed. And so this is fine. This has happened here. This was an inverted hammer with a long tail. We don't even have a long tail. It's just stuck in the middle with the Dow down 122. So the point is that if the body of this candle had closed below this, I would be singing a different tune right now. I would be basically saying, you know what? We got to stay short at that point if it had done this. Do you understand what I'm saying? And I was looking very carefully if they would do that, but the machines didn't do that. Okay? Instead, the machines created believe it or not, this is still a bull flag. See what I'm saying? This is still a bull flag. So, can't make a determination yet. This body, this red candle, this is a weekly candle. The week doesn't end until tomorrow. Could very well expand lower and create pressure downwards, and we have a major support level, which is this line here, 29.15, and then this green line, which was the last time the market sold off like a maniac. That was back in 2018 February, after the big run up in January, and that is 29.02, around there. So basically 2900 is something we've got to watch out for. 2900, 2880, because if we fall that, then we could very easily create a big consolidation that can last for 2 more weeks. I don't know that yet, which would create a massive buying opportunity. This is known as a galloping horse. Look at that. I call it a galloping horse. Made that up a while ago. People like it. Okay, so it's basically a large bull flag with a consolidation channel that can last 2 or 3 weeks. In between, you get up days, down days, but they're generally trending down. So are we in the midst of that? I don't know yet. Don't know yet. Maybe we are going to be in the midst of that, in my opinion, after we hear about the China deal. The market gets euphoric, they run up more, they create a sort of a panic high, just like panic low, like a panic high, and then does it from there. I think that's more likely. That's more likely. Okay. So in the meantime, this is starting to pressure down a little bit. That's fine. It's done that before. We shall see. And my job is to basically keep you all informed as much as possible. And the way we will see, not just on the indices, this is happening, leading stocks like Apple, like Boeing, like Caterpillar, you name it, in the tech side, the Qualcomms of the world, the banks, JP Morgan, if all of them are pushing down, then no reason to be hero. Just go short. Because that's when you're going to start creating this channel. If major companies, I just named a few, obviously there's more, start to really simultaneously start moving down hard, then you're going to get a consolidation channel, which will create a massive buying opportunity somewhere in the low 2800 level. If we fall from here to 2800, you're talking about 600 points. So this would be a 600-point drop or so. Is that doable? Sure, it's doable. We have had many 600-point drops. So all of you are with me so far?
Yes.
Okay. So this was so this session really was to give you a broader idea on what is going on. And then we are going to look at a more colorful chart in the form of the E-minis. This is a more technical chart of Thinkorswim, and which I highly recommend to everyone. And these are showing me the moving averages. These moving averages still trending higher. This is your 20-day moving average. This is your 34-day moving average at 28.84. This is your 50-day moving average. I will tell you that overall, we have hugged this 20-day moving average pretty damn well on every pullback we have seen since last December, since the Christmas Eve massacre, when the markets collapsed 680 points, if I remember, on Christmas Eve. Unheard of. So every single time that we have had a pullback, there's a couple of hundred points, 4 days in a row, 2 days in a row, 1 day, we have basically hugged this blue line. So without guessing too much, this 20-day moving average has acted as major support. And even if we slip and slide a little bit more, the 2900 should hold. But as long as the 34 and the 50-day moving averages remain on an upward trajectory, that means the markets want to go higher. That's all. It's really as simple as that. These are the real highways that the market travels on. Sometimes it moves very far away from it, like we did recently. It's called mean reversion. Now we are basically reverting back to the mean. And the mean averages are these ones. So far, so good. There's nothing there. Now, this is something here that I noticed, which is absolutely wild. Within 24 hours, this is big, okay? This is really big. 1 second. Within 24, and this is exciting. Why is it exciting? Because it's going to give you some massive opportunities to buy some things real cheap, and some of them are getting cheap. Within 24 hours, the full stochastics plummeted. Plummeting. So by the time it gets towards this level here, which is the RSI, Relative Strength Index at 20, it's really quite simple. You can really buy with hands down. In 24 hours, it did this. It's doing this cliff diving. Now, the bad thing is the cliff diving hasn't ended. The cliff diving has to end and it has to turn. But generally, I tend to buy right before the turn. That's where the big money's made. Okay? If it hits 20, you got to buy. You got to buy. If you wait around for the turn normally doesn't show till 24 to 48 hours later. So you'll miss about 200 to 300 points, and then the market basically pulls back a little bit before it goes further. But this is very interesting. There was a lot of forced selling that occurred in the market within the last 24 hours and today. Even though there's a whole bunch of green on the screen, but that's just what it is. All right, so this I watch very carefully, and you guys can certainly do that on your side. On the SPX, this is still a bull flag. We're cliff diving here, but you can see here that this is being contained right on the upper quartile, which means above 50 on the RSI. So it's fine. This is still a bull flag. Look at that. So the next couple of days are going to be very important to watch out. If you look at this chart here, there's nothing here that should scare the living daylights out of anyone, except that we created a flag. I was talking about NVIDIA earlier, so let me show that from a stock thing. So this is the chart of NVIDIA. Let me clean this out by saying clear drawing set. Bingo. So if you look at the chart of NVIDIA, this is pretty, to me, it's very exciting because this is a real company, right? And so it's not like it's some Joe Schmo company doesn't know what they're doing. So basically, if you look at it very simplistically, every time I've shown some of these charts from a longer term standpoint, the one that comes to mind, which was our biggest ever swing trade winner, was Chipotle from $250, $300. From the time that I said this is going to be the ultimate swing, it's on my videos. The stock went to almost 800, and of course it took a bunch of months, mind you. It's not like it happened overnight. But think about it, 250, 300 bucks, and it went to $721. A few months. So this is a very large cup. This is a handle. And I can't remember, did NVIDIA, my head's getting all blank. Did NVIDIA post earnings yet? I don't recall. I hope they didn't, because that's exactly what it's going to do. Let me check on my other screen. Hold on. Does anyone remember? Oh, great. NVIDIA posts earnings May 16. Yay! Booyah! That's great. May 16. Get ready, guys, all right? For a blast. I do not think, personally, NVIDIA is going to disappoint. Now, even if they disappoint, the stock was a $300 stock. So even if unless they really crap, which is highly unlikely, okay, that all segments of their communication chips, their Bitcoin mining chips, and gaming chips. Remember, Nvidia's all in that hardcore gaming, all the stuff. That everything's going to hell in a handbasket. The artificial intelligence chips, then that's a different story. In that case, the stock could be shorted all the way down to 120. But this is a large cup and handle. So just listen carefully. This is big money talk that we're giving you. Not that we don't give it to you guys every day. This is your neckline on this cup. That's $230. There's a gap fill here, which is where the stock went to. There's your gap. Now, I talked about NVIDIA all the way from here, here, here. You all know that. I didn't hold it one way through. We trade it as we move along. But looking at this chart, once in a while in trading, you have to get excited about something. You say, I want to trade this stock. I want to focus on it. I want to stick with it. So you tell that to your mind. I'm not telling you what you guys should think, but I'm just telling you. Pick one or two that you specialize in. I know some of you do. And thanks, Kate. Yeah, I found that same thing. Thank you, Kate. So Kate posted May 16th too. So basically, this is a large cup and handle. And NVIDIA is right there inside this gap. Let's open up this very simple stochastics, which has, like they say, keep it simple, stupid. The stochastics are exactly that's what they are. Let's keep it simple. They don't always work in a straight line up or down, but the more you look at it, the more it talks to you. These are the internal signals, the blood pressure, your cholesterol rate, your sugar level, all kinds of stuff. So this is looking good. Oops, sorry. What am I doing? This is looking good. Okay? Now this is the daily chart. Doesn't matter what happens intraday. This is good. And every single time it's made a turn like that, the stock, it gets overbought and it's made a run. So what kind of run can the stock make? Well, let's take a look at it. Keep it simple. You have a big gap here. 198. Lower gap is 174. So you got 24 points between here and here. Or 23 points. 199, 175. They're 24 points, okay? So you got 24 points in this gap, which is also a trading range. Got it? And NVIDIA has been trading between 174, 190, pretty consistent. So 24 points. If the stock busts a move from here, from 198 to 24, it comes to $222. Bottom line is the stock can go to 220, in my opinion. Right there, there's another gap, which is around 225. Here, you can see that gap right there. See that? Gaps always get filled. It's one of the things about, pretty much. So, and there's a small gap up here. Forget 270. If we can trade, which I think we can, there's going to be volatility. Trade this stock. And a lot of these hedge funds, they do a lot of illegal stuff, mind you. They do a lot of illegal stuff, believe me, all right? They will fake orders, spoof orders in there to look like there's a lot of buy orders coming in. They will sell something. They will buy something with 1 or 2 shares just to push the shares higher, or put in an order for 100,000 shares but not actually execute it. It's called spoofing. You can Google it. Just to throw out fake out the market, okay? And algos do that a lot. Very illegal. And I know they're trying to stop it, but they haven't been able to. It's just so blatantly illegal. It's not even funny. So they do this stuff with NVIDIA and these stocks a lot. Stocks all of a sudden down 13. Alta Beauty, that might trade it, and we were long that. Stock was down for no reason, $4 yesterday. Okay? Stock turned around, went like a monster today. $9. So you think it just happens randomly? Because the hedge funds are trading this stuff. So they'll be doing all kinds of funky stuff to fake you, get you out, and a lot of other players out, and then they run with it. So saying all that, NVIDIA is a large. This is your first neckline. Sorry. Let's do this right. This is the ultimate neckline, 220. Then you got a, there. Here's your cup. Actually, the cup goes all the way to 250. But let's just stick to here. I don't want to push it too much. This is a handle. They might hold the stock down, push it down towards 170, 175. Just telling you. For no reason. Before earnings. The cheaper we can get it before earnings, the better. And then it gives you a springboard for them to, because look, hedge funds, what? They don't like buying low, selling high. That's the business they're in. So if they can scare you out of a trade and push the stock down, they're getting it cheaper. So they'll bulk up around the 175 range or so, which is basically where the moving average is, and 175, 180, and then run it up big. What you don't want NVIDIA to do is to basically break out to 210, come up with earnings that would put a lot of risk in earnings, because that means if they don't blow out the numbers, the stock's going to fall. What you want the stock to do is to stay within this handle, which is between 190 and 175. Understood what I'm saying? That's what you want the stock to do. If its stock runs up to 210 before earnings, yes, it might bust a move. The earnings could be phenomenal and the stock goes to 240, but it dampens the possibility, because if they don't come up with humongous numbers beating, then there's not that much room to move. You'd rather buy the stock in the 180, 190, 175 range and get 15, 20 points on it as it moves towards that 210, 220 level, than buy it at 210 and barely get 10 points, and it might not even get it if it misses numbers. Do you understand what I'm saying? So, all right, that's it. Thank you for attending. Just showcase one stock. There's a bunch of things going on. In the meantime, this market, these algos are on crack, okay? The way they move these markets around, it's like monkeys on a hot tin roof, but monkeys on crack on a hot tin roof, all right? So I don't know if you can Google that. Maybe they, there's some monkeys who got, smoke crack and jumping on hot tin roofs, but sometimes it just feels like that in the middle of the day. So on that note, God bless you all. Connect with you. Thank you for being members here at Clue Estate Trading, and certainly get more great people like you to join us. God bless you all. Good night.
Good night.